Hey, rich friends, it's your girl Cha-Cha reporting live from the Money Mantra, and we are back with another Forex education video. My goal is to help as many people as possible become independent and profitable traders within the foreign exchange market. So if that's something that you're interested in doing, make sure that you subscribe to the channel. And if you find this video helpful, make sure you give it a thumbs up, leave me a comment, or share it with somebody else who you think that it could help. So on today's quick video, I'm going to be reviewing a trade idea that was submitted by one of the students that I mentor. I know I don't mention this a lot on my channel, but I probably should. But I do offer personal mentorship to teach people how to trade, and you can find that information below. So this trade idea was submitted by a student on June 8th, 2023, around 11 o'clock a.m., and he was analyzing AUDJPY for a sell. Now, typically when anybody drops a trade idea in the chat, I will analyze it no matter whether it goes right or wrong, because I really want everybody to learn the mistakes that they're making so that they can correct them and start to make more money than mistakes in the market. So I have a few different numbers here. So I'm just going to go over what went wrong in this trade and why it actually hit stop loss. Now, before we get into that, I do just want to really commend this student on having a really good risk to reward ratio. They had a 25 pip stop loss with a potential TP1 of 50 pips, a potential TP2 of 100 pips, and a potential TP3 of 150 pips. So the risk to reward was actually amazing on this trade. However, there were some fundamental mistakes that were made, which caused the trade to go in the opposite direction of which the student had analyzed. So first and foremost, we are going to back it up. I'm going to turn on replay mode, and hopefully this works. And we're going to start right here, because this is where the student actually entered the trade. So right now we're just going to be paying attention to 1, 2, and 3. So remember, this student decided that he wanted to take this trade for a sell. And his main reasoning for a sell, which I'm not really mad at, was because he saw a lot of resistance right here. So if you guys have seen any of my previous videos, or you've been studying Forex or just chart markups in general, you know that equal highs, right? Once you start to see those equal highs, those are a great confirmation that the market could potentially be turning around. So what I think this student did, because there were a lot of other contradictory confirmations, I think this student took their entry based solely off of the resistance. However, the more you trade, you'll realize that that's not enough. And sometimes, even if you do understand price action, you are going to want to make sure that these indicators are lining up. So the strategy that I will teach my students to fall in alignment with TradingView's free, you get 3 free indicators if you use the free version of TradingView. So I'll use the double EMA, and I'll have my students either choose the MOM or the stochastic. Now, first and foremost, when we're looking at the EMAs are our trend lines. And if the candles are above the trend lines, I'll typically use them as areas of support, and I will try to focus my attention on buys. And I'll just back it up a little bit to show you guys what I mean by that. I'll just back it up a little bit to show you guys what I mean by that. And I don't really have to go back too far, but we can see that the candles are above both of my EMAs here, and the market is continuing to push up. In fact, when the candles are above the EMAs act as a support. So when the candles retrace or pull back to this line, it will act as a level of support, and the market will continue to go up. And vice versa. If I were going to be looking for a sell, what I would want to see is that my candles were falling below the EMA, because then the EMAs would act as an area of resistance. So we can see that here. We see the candles falling under the EMAs, and then we see once the candles get close to the EMAs, it actually acts as a level of resistance. So as we can see, all right, I'm trying to move back over here. So as we can see, when this student took this trade, this was actually where they analyzed it at. And we can see that the first bearish condition was not met which is the candles should be below the EMAs if you're going to look for a sell. So that was the first note, and one reason why this trade did not go how they expected it. Now, the second indicator that I would use to analyze this trade is the momentum indicator. And the momentum indicator literally shows me how I like to use the momentum indicator is typically if the market is going down, right? We see a small series of red candles there, then the MOM will be reflecting the direction and momentum of the market. So it's pretty simple. If the momentum line is facing down, typically you'll find a better sell opportunity. And if the momentum is facing up, right, like we see here, there will be a better buy opportunity. So the second note that I made on this student's trade was that the MOM was actually facing up, right? The MOM was actually facing up, letting us know that this trade was picking up momentum for the buy. So we have two bearish conditions not met. We know we need at least 4 confirmations to feel safe in our trade, and it is nice to have 1 or 2 entry signals. So the third mistake that I noticed that this student made on this trade was the stochastic. Similar to the MOM, the direction that the stochastic is facing will give you some insight into which way the market is going. And not only that, you'll notice 2 lines on the stochastic. There's an orange line and there's a blue line. And in my mind, the orange line represents the sellers and the blue line represents the buyers. So if the blue is above the orange, as we can see here, that's going to be an additional confirmation for a buy and not a sell like this student had analyzed. Not only that, we can see that the stochastic is facing up, again, letting us know that the momentum is going up and not down. So that was enough to steer me away from the trade. I actually did take this trade because any trades that my students drop, I always take because you have to trade without fear. It's really not that serious. The trade's either going to go your way or it's not. So because this was a sell limit trade, meaning that this student expected the trade to go up before it came back down, I also analyzed what actually happened once the trade triggered. So 1, 2, and 3 was commenting on the analysis that the student did to decide whether or not they should take the trade. And 4, 5, and 6 is what actually happened once this trade played out. So what we should see based on what we just analyzed is the market pushing up and not down. So I'm going to hit the replay and we're going to see what happens. All right, again, as you guys can see, the market was using that bottom line as a support, right? It was using that bottom line as a support. And once it got close to that level, once again, right here, we can see that the market actually decided to go up because more bullish or buying conditions were met versus selling conditions. So once we were actually into the trade, it looks as if the market conditions would have been met. If he would have taken the trade up here, it probably would have worked out a little bit better because if he would have seen more things. But for now, we can see that the candles are still above the EMA, right? Which means bearish conditions for a sell still have not been met. So we have 4 strikes against this trade. We need 4 pluses to get in it. So we'll just have to do better next time. The 5th mistake that was made on this trade was the momentum line, even though it has this distinct bend, and I don't really talk about this too much, but this distinct bend typically does signify a reversal. But I always like to tell my students, trade what you see and not what you want. And in this case, we can see that the blue momentum line is clearly very highly above the 0 line. And whenever the momentum line is above 0 or facing up, like it is here, that is giving us confirmations for the buy and not the sell. So the last mistake that was made, and this is where it gets a little tricky because the stochastic is a great indicator to let you know the momentum of the market. but it also tells you when price is oversold, meaning it's going to buy soon, or when it's overbought, meaning it's going to sell soon. Now, a common mistake that I see a lot of people make is that as soon as, and I'll have to zoom in down here. Let's see. See if I can zoom into the stochastic, y'all. All right, so a common mistake that I will see people make is as soon as the market, right, reaches above this area, right, they'll consider it overbought and they'll automatically start to sell. But just because it is overbought, right, that is our confirmation for the sell. But our entry signal, we would have to wait for the market to cross back down, right? It can't be up here. It would have to cross back down into this territory to confirm what we want to see for the sell. But I'll zoom out and we can see that's actually not what happened. We can see that the market was overbought, but when this trade triggered, the crossover had not quite happened yet, meaning the market probably spent a little bit more time up here, which it did. We can see the market spent a little bit more time up here, and it still hasn't actually begun to sell yet, right? So those were all of the mistakes that were made, and this is how I will let people know in the chat. I don't want anybody to be embarrassed about the mistakes that they made, because I've been trading for almost 3 years and I've made every single last one of these mistakes, and I'd rather help somebody fill in the gaps of what they don't know so that they can become profitable instead of making them feel bad about what they don't know. So this is just my breakdown and quick description about what I saw went wrong with this trade. And if this student had analyzed it for a buy, then they would have seen some profit in this trade. So the best thing about this trade is that the risk to reward was perfect, right? So even if this student only risked 10 cents per pip, they only lost $2.50. And if they risked $1, they only lost $25. So it's really not that bad in the grand scheme of things. I always like to tell my mentees as well that consistent winners take losses all the time. And when something like this happens, you just have to dust your shoulders off and come back either into another trade or come back another day. But really don't stress about it, because we're not market makers and we can never really fully predict what the market is going to do. So I really hope that this video was helpful. If you learned something today or you saw some mistakes that you could be making in your trading, definitely feel free to subscribe to the channel. If you want to learn more about this strategy, I just call this the double EMA and MOM strategy. You can find that on any one of my Forex playlists. But that is all. Until next time, rich friends.